All right, gentlemen, ladies, these are the topics we have already done. We have some areas to cover from 2.3, and then we will start 2.4 tonight. So let us resume from the exact point where we left out yesterday. And it's going to be this example. I hope you remember. In the previous lecture, we discussed that if you use FIFO perpetual, where you consider every purchase and sale separately, and if you follow FIFO periodic and FIFO perpetual, they give you the absolutely same result. Same gross profit, same valuation of inventory, same cost of goods sold. Keep that in mind. FIFO periodic and perpetual, they give you the same numbers, but not LIFO, not weighted average. Let us discuss as we go along. We have another question. This is the question we've done in our previous class. Okay, now we have been given a table. Illustrated below is perpetual inventory, showing you when the goods were bought, when they were sold. Each line is given separately. It further says that there was no beginning inventory. The items sold on March 15th were purchased on January 12th. The items sold on July 8th, they were purchased on May 5th. Fine. The ending inventory balance under first in, first out. Since we have learned that FIFO periodic and FIFO perpetual, they give you the same results. So we are not going to go for the complexities of perpetual system. What we will do, we will see how many units did we purchase during the entire period, including opening stock. So it shows that we have 2,500 total elements. There was no opening stock. So these are the goods available for sale. 2,500 units were available for sale. All right. Out of these units, we sold 800. So out of 2,500, 800 units have been sold, right? That means our closing inventory, closing stock consists of 1,700 units, right? Since the cost flow assumption is first in, first out, which means the items that we have sold, they were sold from our earliest costs or from our earliest purchases, which means that our closing stock of 1,700 will consist of all the latest prices. So let us see and look at this latest purchase. So it means out of these 1,700, our latest price is for these 1,000 units at the rate of 1.65. Then these 500 units to be valued at the rate of 2.2. And we still have 200 units, and these 200 units would be valued from the earliest purchase to. So if you calculate 200 times 2 plus 500 times 2.2 plus 1,000 times 1.65, it should give you, Fahad, please revisit your computation. It should give you 3,150. This is the value of closing stock using FIFO periodic. You will get the same result using FIFO perpetual. What FIFO perpetual does, it considers each sale and purchase separately and then goes for the valuation in the last. So this is going to be B as your correct option, as you can see. All right, now the same idea that I've just told you, the inventory method yielding the same inventory measurement and same cost of goods sold, which means same gross profit, whether a perpetual or periodic system is used. Please remember, periodic system is very straightforward. At the end of the day, at the end of the year, quarter, or the month, you simply value your stock and you find your CDS and closing stock. But in perpetual, every purchase, every sale must be treated separately and valuation is done accordingly. This is much more a longer period. And interestingly, that is not what you're likely to be tested. So as I said, that only method that gives you the same numbers, whether you use perpetual and periodic, is the first in, first out. Otherwise, average cost, they have different numbers under perpetual, periodic. LIFO, they have different numbers. I'm going to prove these to you with the help of an example as we go along, that they show different numbers and sometimes significantly different numbers. All right, so we got B to be the correct option. Now, last in, first out, called LIFO. I told you yesterday, when we say LIFO or FIFO, it doesn't mean the items, the oldest items are sold first or oldest items are bought first or whatever. It's just costs. Last in, first out method, it assumes that the oldest costs, the items which purchased earlier at the oldest cost, oldest costs go to the ending inventory. And the items that we have recently purchased, the latest in, the recent cost, they are charged to CGS. This method is totally opposite to the method we have discussed in FIFO cost flow. LIFO is totally opposite. The recent costs go to CGS and your oldest costs, they go to the ending inventory. Remember, LIFO is not permitted under IFRS. Was, G, please remember, LIFO method is not permitted under IFRS. It is not permitted in Indian standard. It is not permitted previously in the UK base. They had their own accounting standards. LIFO method is only permissible in China and in the US. Exactly. Right, gentlemen, let's move on. So let us try to apply this concept on some numbers. If you say, sir, this is the perpetual inventory card, I will say, no, this is not the perpetual inventory card. Why? Because I have just been given how many goods I purchased and it doesn't show when the items were sold. No information whatsoever regarding the sale, right? So that is the reason this is not a perpetual inventory card, because perpetual should show me when these items were sold at what date. So if I am required to calculate the LIFO inventory, the only method that I can use is the LIFO periodic. Now, what is LIFO periodic? Look at this. It's a very straightforward method. LIFO periodic will say, okay, how many goods you had available for sale, including your opening stock plus all the purchases. If you add all these, you will have 2250. That's the goods available for sale. Out of these, I have sold goods 1050 units and 1200 are still with me. So if you add these two up, you will get 2250. All right. The LIFO cost flow method tells us last in, first out. It means the items that we have sold that have been charged to CGS, these items must be from the latest purchases, right? Last in, these are the items last in, and they are the one that are first charged to production. They are the one that are charged to cost of goods sold. So which means out of these 1050, let me write these down one by one. I will have 200 units to be valued at 5.9. I will have 250 units to be valued at the rate of 5.80. I will have 300 units to be valued at the rate of 5.60. And out of this 500, because if you add all these, you'll get 750. Out of these 500, I will have 300 units to be valued at the rate of 5.3. If you total this all, this will give you the cost of goods sold. And as per the numbers, it is going to be 5900. Right. Now, ending inventory will consist of the oldest costs. 1200 items will be, 1000 items will be at the earliest price 5.25. And the remaining 200, they will be valued at the rate of 5.30. So remember, your latest costs are charged out first. And your oldest costs, they become part of your closing stock. So when you multiply, you will get, and you should get 6310. So this is the value of your ending inventory under LIFO, and this is the value of your cost of goods sold under LIFO. And remember what I have done, this is called LIFO periodic, because I didn't match my sale and each purchase, sale versus each purchase. That is done in perpetual. That is periodic, pretty straightforward. And this is the method you would be tested on your exam. So I have selected a couple of questions that, see, these are the numbers, cost of goods sold, and your inventory number. So this is the ending inventory. This is the cost of goods sold. All right. Now, the question here. In periods of rising costs mean when the prices are increasing. When the prices are increasing, which of the following inventory cost flow assumption will result in higher cost of sales? Right. Now, let us discuss. When the prices are increasing, we want to charge higher prices to cost of goods sold. So when the prices are increasing, latest prices, when they're charged to cost of goods sold, that means you're talking about LIFO. Because under LIFO, the latest costs, the newest costs, they are charged to cost of goods sold, last in, first out. So if you want to have higher cost of goods sold, which I would wonder, why would you like to do that? But let's say if it does, if it happens, when the prices are increasing, the highest costs are charged to cost first. So this happens under the last in, first out method. That is the topic we are currently doing. All right, now let's do next the average cost method. Under average cost method, what we do, this is pretty straightforward. Under average cost method, we will simply calculate the total goods available for sale and divide them with the total number of units available for sale. That will give us a single rate. You can apply that single rate for all the sales, all the cost of sales, all the closing stock. This is again a very pretty straightforward concept, right? Simply you'll take the value of all the goods available, total value, divide by the number of units. So you will get an average rate, and you can use that average rate to calculate your CGS and your closing stock. So it's pretty straightforward. Like, this is the total value of the goods available in the opening stock plus what you bought. And these are the total units you had, 1,500, 300, and all these, right? So when you divide the total value of your goods available for sale with the total units available, you will get what you call the unit rate. 5.42667 is the average rate. Now you will use the same rate to calculate your cost of goods sold, 5.42667. When you do multiply, you will get the value of closing stock, which should be 1,050 multiplied by 5.42667. It gives you 6310, Imran says. All right. Then we have, and the ending inventory, it will be valued at the same rate, 5.42667. So 1,200 multiplied by 5.42667, it gives you 6512. So this is the value of your cost of goods sold. This is the value of your ending inventory under the weighted average method. Now, if you ask me what kind of computation it is periodic. Why? I didn't see when the goods were bought, when they were sold. I just simply calculated a single rate. Okay, just a minute. My computer screen is stuck here. Okay, little correction. 1,050 multiplied by 5.4226267. This will give you the cost of goods sold, a single rate to value your cost of goods sold, and the same rate, 5.42667, you will use this to value your closing stock. So this is periodic, remember, 6512. This is the value of your ending inventory. This is the value of CGS. This is periodic, gentlemen. This is the periodic calculation of your CGS and ending inventory. So you will now see a question where I'm going to apply perpetual valuation method and periodic, and you will see the difference. So I hope that is the question we have here. Yes, this is the one. I'm going to apply 4 different methods on this question. I told you FIFO, periodic, and perpetual, they give you the same number. But LIFO will have different numbers for periodic and perpetual. So is the average cost. So let us first do what is required here. Under the moving average method, what amount should Metro report as inventory? All right. What we have learned so far was weighted average. Under weighted average, what did we do? We calculated a single value for all inventory and divided with all the units available. You had a single rate which we applied to CGS and to your closing stock. But under moving average, remember, moving average is used under perpetual method. Remember, moving average is used in perpetual method. Average cost method or weighted average method, that is for periodic. In periodic, I didn't distinguish between what I bought, when I bought. I simply calculated all the value of my inventory divided with the total units available. I used a single rate to value my ending inventory and my CGS. This is weighted average. And this is periodic, right? But in this question, you are required to calculate the value of closing stock using moving average. And moving average is used in perpetual. Now, what is perpetual? You will see. Every purchase and sale revises your inventory records, revises your cost to be used in calculations. Now, what I'm going to do, I'm going to solve this question using first moving average. Of course, that would be for the method we are currently doing. Then I will do the same question using periodic. Then I will do the same question using LIFO periodic. And I will do it using LIFO perpetual. You will see the numbers of closing stock will be different in each case. LIFO perpetual. All these methods, it will take time, but I think it should be done. So you people should have a fuller understanding how things work. All right. So under moving average, I had opening stock of 1,000 units at the rate of 1 each, which means the value of my opening stock was 1,000. When I purchased goods on 1st of July, probably, I purchased 600 units at the rate of 3 each. The total value of these items is 1,800, right? Since now I have a total of 1,600 units, I must calculate an average rate now. So what I'm going to do, 1,000 plus 1,800 gives me 2,800. This 2,800 is the price for 1,000 plus 1,600 units. So this gives me a value of 1.75, right? I sold goods on 1st or 20th of January, probably. 900 units were sold. And what would be the CGS? 900 multiplied by 1.75, the rate that was established just before the sale. We are not interested in sale. We need to find the value of closing stock. Now what happens? Out of these 1,600 units, 900 units are sold, which means I only have 700 units to be valued at 1.75, right? And I purchased 400 more units at the rate of 5, which has a value of 2,000, which means first 700 multiplied by 1.75, that should give me 700 multiplied by 1.75, 1,225. This is equal to 1,225. To this, I add the goods I purchased, 2,000, which means the value of my closing stock under, I should have written, this is the moving average method. It is $3,225. This is the value of my inventory under moving average method as per the question requirement. Now, if you ask me what is going to be the rate, average rate, you will calculate 2,000, the total value you bought, plus 1,225, which was available previously. Adding these two together, 2,000 plus 1,225, total is 3,225. And how many units are there? 700 plus 400, 1,100. So your new rate is going to be 3,225 divided by 1,100. See, every purchase revises your rate. Nabil, absolutely right. Subhan, perfect. Right? So look at the number 3,225. This is the value of inventory using moving average. Now let us do it using periodic. Periodic is straightforward, straight. I don't go for the niceties. Under the periodic method, what I do, I simply add all the items of inventory, 1,000 plus 1,800 plus 2,000, 1,000 plus 1,800, 2,800 plus, that is 4,800. 4,800 total purchase, including opening stock, for how many units? 6,000 plus 600, 2,000 units. So this gives me an average rate of 4,800 divided by 2,000. It gives me 2.4. All right, how many units do I have in the closing stock? I have 1,100 units in the closing stock. How do I know? 1,000 were opening, 600 bought, 1,600, 900 sold, 700 plus 4, 1,100. So look at this, people. Look at this number. 2.4 multiplied by 1,100 is an entirely different number, 2,640. So they're both average cost method, but this is the moving average where the rate is revised after every purchase. But this is the weighted average where I didn't care when I bought, when I sold. I simply calculated a single average rate and applied on all the items in inventory. Right now, let us do this. LIFO periodic. I told you, you people will be tested on the periodic method on your exam. But I believe that you should know how the perpetual method works. So let us first do LIFO periodic, which is pretty straightforward. LIFO periodic means all you have to see how many units you had, total 1,000, total of 2,000 units. Out of these 2,000 units, you have sold 900 units, which means 1,100 units are to be valued using LIFO periodic. Last in, first out. All right. So what I'm going to do, if I have 1,100 units, and if I want to value their inventory, value for the purpose of inventory, they must be split into two parts. First, these 1,000 units, last in, first out. Latest cost have been charged to production, which means these 1,100 units must be valued at the oldest possible prices, which means these 1,100 units, 1,000 unit to be valued at 1, remaining 100 unit will be valued at the immediately falling rate, that is 3. Now look at this. The value under periodic LIFO is just 1,300. No. Look at this, Subhan. 1,100 units not to be valued at 3. 1,100 units, we just have 1,000 units at the rate of 1, and the remaining 100 units to be valued at the rate of 3. This $1 will be used for the first 100 units, and the remaining 100 units will be valued at 3, so which means 1300. So this is LIFO periodic. Same question, same number. Now I'm going to apply LIFO perpetual. Look at this, what happens now. Under LIFO perpetual, I will need to first clear up screen for you guys so that you understand the idea well. Last in, I need to find the inventory, Subhan. Inventory. Last in, first out. It means your latest costs have already been charged to CGS. Your inventory will consist of your oldest costs, oldest prices. Okay, inventory. Last in, first out. Latest cost go to the, no problem. Latest cost go to CGS. Oldest cost go to for valuation. Now, LIFO perpetual. In this method, I will have to compare and match each and every transaction. Now, look at this. When I had 1000 units at the rate of 1 each, 600 units at the rate of 3 each, when I sell these 900 units, last in, first out, last in, first out, last in, first out, which means if these 900 units are sold, they would have been sold first from these 600 units, and the remaining 300 units would have been sold from the opening stock, which means opening stock will now consist of just 700 units at the rate of 1, and these 400 units that I've just purchased, they are still there at this value. So 700 times 1, 700, and 400 times 5, that is 2000. Now look at the value of inventory under LIFO perpetual. Huge difference. That is the difference. Under periodic, the numbers are different. LIFO periodic, LIFO perpetual gives you different answers. Average cost periodic, average cost perpetual, they will give you different answers, right? But FIFO periodic and FIFO perpetual, they will give you the same answer. That's the point I wanted to make. So please, after the class, watch this specific part of the video so that you can fully understand how periodic and perpetual work, So you should get better understanding about these so that if any question comes in the exam, you should be able to tackle it well. So right now here, where you're required to calculate the value of inventory using the moving average. So this is the moving average right here, 3226 and 3225, that is B. B is the right answer and B it is. Now here is an important conclusion that we need to draw for the numbers above. Yesterday we discussed that whichever method results in higher closing stock is a deduction from cost of goods sold. If cost of goods sold is understated, and this means your gross profit and your net profit, they will both be higher. And if the closing stock is understated, you will see the reverse effect here. Now, look at this. If I use moving average for valuation of my inventory, this is giving me the highest value. This is giving me the highest value for my closing stock. This method should give me the highest profit. So whichever method gives me the highest closing stock, that method will give you the highest level of profit. Now look at this here. We have all these examples we did now and yesterday. The method that is giving us the highest level of closing stock is FIFO. And look at this method is giving you the highest profit. The method that had the lowest closing stock value, which is LIFO, it is giving you the lowest profit. So that's the point you need to understand. The method that results in highest closing stock is a deduction from your CGS. A lower CGS means you will have a higher gross profit, and a higher gross profit means you will have higher net profit number. Yes, Subhan, you got it absolutely right. People, remember, moving average is for perpetual average cost method, right? And weighted average is for periodic. And I'm sure you've understood LIFO periodic and LIFO perpetual. I'm telling you again and again, on your exam, mostly students, I would say all the students have been tested on the periodic method. But despite that, I believe that you should know how the perpetual system works. So here we go. The cost of material has risen steadily over the year. Prices are going up. Which of the following method of estimating ending balance of material inventory account will result in the highest gross profit? Now you have to think. Do not just jump on the question. You have to think which method will give me the highest profit. That method will give me the highest profit that result in the lowest CGS. The lowest CGS, because when the CGS is lowest, you will have the highest level of gross profit and net profit, right? So if the prices are rising, and if you're using FIFO means your oldest costs, they are charged to CGS, oldest lower cost, they are charged to CGS. Hence, your CGS is lower. Resultantly, your gross profit would be higher and your net profit would be higher. Or in other words, you can say under FIFO, your inventory would be at higher value. Your closing stock would be high. A higher closing stock means your cost of goods sold would be low, and lower cost of goods sold means your gross profit, net profit would be higher. So that's the idea. Moving on. Now, this is a comparative analysis between these three methods we have done. First in, first out method, under what circumstances you think you should use it? Or what's the benefit or advantage of using FIFO? FIFO is good because under FIFO, your closing stock will approximate the current prices because the current cost, they are in your closing stock. FA says, why always we assume the latest cost will be highest? It is the general phenomena, my friend. Prices are continuously rising. You are in the Middle East, so you can say so. When I was in Saudi Arabia, I got Pepsi can for 1 Riyal for many years. The judge who had a cost of 10 Riyals. So the prices stayed the same more or less in the Middle East, UAE and Saudi Arabia. But look at what is happening in Pakistan. Prices are continuously rising. So that happens across the world. Prices generally rise. So that's normally you will see 5 Riyal shawarma. So things have changed, gentlemen. Now the prices are rising in the Middle East as well, right? So first in, first out is good because it will approximate the value of inventory to the current prices that are prevalent in the market. Last in, first out, this method is good because last in, the latest costs that you have just paid, they are charged to CGS and hence matched with the sales. So your current costs get matched with your current revenue. So this applies matching concept beautifully. It better matches your current cost and current sales because your cost of sale is on the current cost and your sale is on the current prices. So matching concept is nicely applied here. And when you want a midway house weighted average method, this smooths out the prices changes over the period. So that's what you can do if you want to have a consistent profitability. As I said, LIFO is only permitted in China and in the US. US GAAP allows LIFO, and there is separate valuation we'll discuss in the later part of our lecture. But under IFRS GAAP, under IFRS, LIFO is not permitted. LIFO is not allowed under IFRS. Keep that in mind. So what we have learned so far, it has been nicely summed up here in this table. During a period of inflation, Fahad, prices continuously rise. Maybe the rate of increase sometimes slows down, but the prices generally tend to rise across the world, everywhere. So during a period of high inflation, low inflation, inflation basically is defined as the persistent increase in general price level. When the prices are constantly rising, we say the rate of inflation is high. And when the prices are rising, but at a slow rate, we say the rate of inflation is low. So during a period of inflation, when the prices are rising, under LIFO method, last in, first out, your recent costs, which are high cost, they go to CGS, which means your CGS would be high. Higher CGS means your gross profit would be low, your net profit would be low, right? And of course, your ending inventory would be lowest because it is valued at the oldest cost. Apply the same concept on first and first out. If the prices are rising and you apply first and first out, which means your oldest costs, low costs, Purani cost, they are charged to CGS, which means they are low. Since you have low CGS, that means you will have higher profit and higher net profit. So this is just the summary of what we have done so far. Now we move to the last topic of your chapter number 2, and this table is a summary of what we are going to do. This table is the summary of what we are going to do in the coming half hour. Now, if we are using IFRS and if you're using US GAAP, please excuse me for this GAAP. This is not GAAP, this is GAAP, GAAP. Okay, now comparing these two side by side so that you can have comparative understanding. FIFO method allowed under IFRS? Yes. Allowed under US GAAP? Yes. Average cost method allowed under both systems? Yes. It's your choice when you want to go for FIFO perpetual, FIFO periodic. GAAP and IFRS, they have no concern with it. Average cost, moving average or weighted average, no concern. Now, this is the difference. LIFO is allowed under the US GAAP, but it is not allowed under the IFRS. You need to keep that in mind. Right? Now we are going to study two rules, NRV and LCM. They're pretty straightforward. Some people just don't mess it up. I don't know. We will discuss these two rules for valuing inventory. So what is the topic right now? Measurement of inventory subsequent to initial recognition. Initially, you might have valued your inventory on FIFO, average cost, LIFO, specific identification method. But once you have valued your inventory by any of these methods, subsequently, what if the prices fall or what if the prices increase? How do we account for it, for these changes? What if the goods have lost their value? We can't keep them at a higher cost because accounting concept of conservatism does not allow us to carry a higher value of items in inventory, whereas the market value may have fallen. So we will discuss the NRV rule and LCM rule. Now listen to me very carefully. This is a very fine point and you need to grasp it well. NRV rule, which we are going to study in the next slide, under IFRS, it is applicable on all valuation bases, whether it is FIFO, whether it is average cost, whether it is specific identification, right? But NRV rule under the US GAAP is applicable on all except LIFO and retail method. Retail method is not in your syllabus, so we will be focusing LIFO only. So under the US GAAP, NRV rule is applicable on all except LIFO and retail method. Then what we do with the LIFO and retail method? Under LIFO and retail method, we have a separate rule called the LCM rule. This LCM rule, you people will study for the first time. Those who are from ACCA or CA background, they would have read the NRV rule, but under the US GAAP, there is the rule that you may not be familiar with. It is LCM rule. IFRS does not allow LIFO. This is right here, Subhan. So remember, gentlemen, NRV rule is applicable on all bases under the IFRS, but NRV rule is not applicable on LIFO and retail method, and all methods fine. Okay, moving on. Then what do we use for LIFO and retail method? For LIFO and retail method, we have a separate rule called the LCM rule, which we are going to discuss in our subsequent slides. And this LCM rule is not allowed under the US GAAP. Gentlemen, please take the snapshot and share it in our group. I saw there were 4 snapshots in the group. Most of you sent it. So just please take the snapshot, share it in the group. So it will help you people to just have a quick grasp on how IFRS and US GAAP they differ. Please do that. Then I will move to the next slide. Done? Okay, I got the confirmation on the WhatsApp. Okay. So that's what we're going to do. Now let us first discuss what is NRV. And what is NRV rule? It is applicable when we want to measure inventory subsequent to initial recognition. We bought the inventory, we valued using FIFO or average cost. Now some things have changed. Market price have fallen. Our cost is higher, the market price is low. So we can't carry our inventory at a higher price. We will have to correct the difference. That is why it's called measurement of inventory subsequent to initial recognition. After the initial recognition, how are you going to value our inventory? So please, gentlemen, focus. NRV rule, which is applicable under all bases in IFRS and all bases under US GAAP except LIFO and retail method. For LIFO retail method, we have a separate rule called LCM. Okay, let's do it. What is NRV rule? Or first of all, you need to know what is NRV is the difference between your final selling price. I'm going to write it as FSP for short. Final selling price minus cost to complete and minus cost to sell. The final selling price minus cost to complete minus cost to sell. This is called the net realizable value. So what you do under the IFRS and also US GAAP, you will take NRV on one hand and you will keep the cost on the other hand. Whichever is lower will be considered the valuation basis subsequent to initial measurement. Now let us apply this on this question here. We have been given 3 items: gear, stuff, and wickets. Under IFRS, what amount should Stockholm compare with historical cost to measure the amount of at which the wickets should be measured? So remember, you have to compare your cost. That cost could be FIFO based cost could be weighted average, specific identification, whatever cost convention, your choice under IFRS. So my cost of wickets as shown by the question is 53. Now I must match my cost against NRV. So I need to first find NRV. What is NRV? NRV is the final selling price of wicket, which is 73.75. Cost to complete is given as 2.5, and it also includes the cost to sell also. So cost to complete and sell, if you calculate the difference, is going to be 73.75 less 2.5. It is 71.25. Now, on one hand, you have cost. On the other hand, you have NRV. Whichever of these is lower. So which of these is lower? Cost. Cost is already lower than NRV. So do nothing. We don't need to do anything. Do nothing. We don't have to do anything because cost is already lower than NRV. So we don't need to do anything. Halas, it means inventory has to be reported at 53. Let's say, just for the sake of discussion, let's say if the value of NRV is just 21.25, whereas the cost is higher, which means your books are showing the value of your inventory as 53, whereas the market NRV is just 21.25. The differential is the loss that you must recognize. Yes, we got the answer. C is our answer. So we must match our cost with NRV. This is the NRV, 71.25. So let's say if our NRV was 21.25, in that case, your inventory is overstated. We must bring the inventory down. Please, gentlemen, please listen to me very carefully. 53.21.25, which means my inventory has fallen in value by $31.75. You have to book this as a loss in your books of account under IFRS. But subsequently, by then, if the NRV goes up, let's say the price goes up and the NRV now is at 70. IFRS allows you to reverse the loss in subsequent period. I can take my inventory back to 53. I can only reverse this loss that I previously wrote off. I cannot go beyond that. Listen to me. IFRS allows you to reverse the inventory loss in subsequent periods, but the write up must not be more than the previous write down. You cannot take your inventory up than 31.75, more than this, because that was your previous write off. We will discuss this concept in our subsequent discussions. Now let us discuss LCM rule. Let us first discuss, I told you, and I'm going to tell you again and again and again, LCM rule is only applicable if the inventory basis is LIFO or retail method. And it is only permitted under the US GAAP, right? Now, what this LCM rule is, it's something new for you guys. There is one conventional approach as given in the slide, and then another desi approach. Whichever approach you like, you will get the right answer. It's totally your choice. Under the US GAAP, LCM basically stands for lower of cost or market price. LCM basically stands for lower of cost or market, which is given right here. Lower of cost or market, LCM, L, C, and M. That's why it's called LCM rule. How it works, there are some numbers we need to first calculate. LCM rule says, first of all, you will have to determine your NRV, which we have just learned to calculate. NRV, we know. NRV is the final selling price minus cost to complete and cost to sell. This under the US GAAP is called ceiling. Your market price cannot be more than this number. Fine. Then if you deduct your normal profit margin from your NRV, this will give you the floor. What does it mean? Your market price, your designated market price cannot be more than the NRV. Your designated market price cannot be lower than the floor. The third element you must consider is the replacement cost. It means this is the price at which you can purchase inventory from the market. Replacement cost can sometimes be more than ceiling, sometimes it can be less than floor. So replacement cost will only be considered if it falls between the ceiling and above the floor. If replacement cost is more than ceiling, let's say, let's put some numbers to make it understandable. Let's say your NRV is 100 and your normal profit margin is 10, which means your floor is 90. If your replacement cost is 93, then it will fall between these two numbers. Only then it might be considered. If your replacement cost is, let's say, 110, it goes above ceiling, hence we ignore that. If your replacement cost is less than 90, which is, let's say, 85, we ignore this. Replacement cost is only considered when it falls between ceiling and the floor, right? That's the idea. Now, when you select these three, you have to, let's say if your replacement cost falls between these two, this is going to be your designated market price, right? You will compare this designated market price with your cost. If the cost is more, that means you have to bring your inventory. Let's say if your cost is 98. That means you have to bring your items down to 93. The differential $5 would be lost. But let's say if your replacement cost is not 93, your replacement cost is 110 above the ceiling. We will ignore that. We will ignore 110, then we will compare our 98 with the ceiling. Right? If your replacement cost is below the floor, 85, then we will ignore the replacement cost, then we will compare our 98 with 90. This is the method given as per your textbook, as per the different accounting literature, based upon the US GAAP. Now let us do this with a Desi method. This is much more convenient. My students have always found this method to be much more manageable rather than ceiling and floor. We are not going to go for these niceties. We're going to do some Desi level way of doing the question. Let us apply this concept directly on a question. That which of these should we consider and how do we consider the loss? Ceiling and floor, I'm not going to go for that. I'm not going to go for ceiling or floor. I'm going to go just for 3 numbers, and then I'm going to make my decision that should I write down my inventory or should I do nothing? Let's do this right here in this question. That will make much more sense. Let us do it. Let's do it first for gear. I have to have 3 things in any order. I need my NRV or replacement cost, or NRV minus normal profit margin. I need these 3 numbers as per the previous. In any order, doesn't matter. In any order, I need replacement cost, NRV, and NRV minus normal profit margin. These are the 3 variables I need to select my designated market price. So for going for gear, my replacement cost is given as selling price. Current placement cost is 203. All right. Then NRV can be calculated by taking your selling price and deducting cost to complete and sell. So 217 less 19 gives me 198. And from this NRV, if I deduct the normal profit margin, which is 32, it gives me what you call the NRV minus NP. I'm not going to say anything floor or ceiling, Mafi, straightforward. Now I have my replacement cost, 203. I have my NRV, and I have my NRV minus normal profit margin of 32. This is 166. No ceiling, no floor. Now, please, gentlemen, tell me which of these is the mid number. Manjala number ढूंढें इसमें से. Which of these is the mid number? Neither too high nor too low. The mid number. Yes, mid number is NRV. Correct. Mid number is NRV. So this is going to be my designated market price, and I'm going to compare this number 198 with my cost. And what is my cost? 190. So gentlemen, 190 versus the mid number. My cost is 190, and the mid number, which is the designated market price, tells me that my cost is still lower than the designated market price. Halas, I have to do nothing because my cost is already lower than the designated market price. Right? So do nothing. Let us repeat this with another set of numbers for the second item, and let's see how things change then. Mid number. Okay, now let's apply this. Subhan, let us see this stuff, then we will move on. The next question stuff. Anyone agrees with Salman? Sir, I think mid number is NRV minus not net profit. Was it? NRV 217 less 19 less normal profit margin. It was 166. Whereas your replacement cost was 203. Let me do this again. Salman, if I find this incorrect, then you are going to pay for it. You are going to pay for the wasted time. So your NRV is NRV minus normal profit margin is 166. Your replacement cost is given as 203, and your NRV 217 less 19. 217 less 19. That is 198. For God's sake, 198 is the mid number, NRV. So you compared 198 with the cost, that is 190. Since cost is lower, this was the waste of time. This was a waste of time. Please, we have very tight schedule, people. Focus. Okay. Mid number, the middle number, that is Not too high, not too low, somewhere in between. Okay, now don't look at the circles. Which circle is in the middle? Look at what number is the middle number. Don't go for the circles, please. All right, next is stuff. The cost of stuff is 106. The replacement cost is given as a current replacement cost 105. NRV, that is the selling price minus cost to complete and sell, 145 less 8, it's 137. And from this NRV, if we deduct the normal profit margin, that is 29. So your NRV minus normal profit margin is 108. Now tell me which of these is the mid number. This time, the mid number is 108, right? So we are going to select this as our designated market price. And we will compare this with our cost. Now comparing this with our cost is 106, whereas designated market price is 108, which means still our cost is low. So you don't need to do anything. No need to write it down. Still the cost is higher than your designated market price. And what is designated market price? The mid number of these three. The mid number of these three. Let us apply this on the third question so as to reinforce our understanding. No one learns accounting without solving lots of questions. It's all about the practice. The more you practice, the more refined your concept would be. Let us try this on wickets. Wickets have a cost of 53. NRV 73.75 less 2.5. 73.75 less 2.5. It's going to be 71.25. Your replacement cost is given as 51. And NRV minus normal profit margin of 21.25, it is going to be 50. Now look at this. What is going to be our mid number, the middle number out of these? The middle number is neither too high nor too low, so it's going to be 51, right? So this is going to be your designated market price, and you're going to compare it with cost. Now we have a problem. We are carrying an item in our inventory that has a cost of 53, whereas its designated market price is 51. Which means we have to write $2 loss on every item. Let's say there are 1,000 units of wickets and they have fallen in value by $2, which means we are going to write off our loss by $2,000. This loss, once written off, is gone. You can't reverse the loss. Under the US GAAP, loss cannot be reversed. Cost, this should answer your question. GAAP is stiff, gentlemen. Ladies, GAAP is stiff. Once you have written off a loss, even if the price goes up, you cannot reverse the loss. But look at this, IFRS. Lovely. IFRS allows you reversal of this loss subsequently if the market price goes up. Right? So under the US GAAP, inventory once written down cannot be subsequently reversed. But under IFRS, reversal is allowed only up to the amount that you previously wrote off. Now, let us do the same. Let's say if it was under IFRS, or let's say even it was under US GAAP, but it was for FIFO based inventory, for specific identification, or the weighted, anything else other than LIFO and average cost method, retail method. So what we are going to do, we are just going to compare our cost with NRV in each case. Let us do it for gear. I'm going to apply now the load of NRV method. LCM is done. For first item, the cost is 190. The NRV is 217 less 19. 217 less 19, it's 198. So in the first case, your cost is still lower than NRV. So you will keep your stock at same price, 190. You need to do nothing. So your cost is 190. So under IFRS or under US GAAP, FIFO, specific identification or average cost method, the cost is fine. In the second question, when the cost is 106, NRV is 145 less 8. Still your NRV is higher, so you keep your inventory at cost. And in the third case, where the cost is 53, NRV is the final selling price minus cost to complete and sell. Still your NRV is higher, cost is low. So keep your, in all these cases, costs were lower than the NRV, so we will keep the items at cost. This method, cost versus NRV, it is applicable on all valuation method under IFRS and except LIFO and retail method, all methods under the US GAAP. Right, gentlemen, I hope that cleared the idea. Now we have a question here. using the lower of cost or market LCM rule, which definitely means, gentlemen, this is the US based LIFO based inventory. So under the lower of cost LCM method of measuring inventory, what is the market amount of this unit? Market amount, designated market price. So you need three circles in any order. The first is going to be NRV, then is going to be NRV minus normal profit margin, and the last one is going to be the replacement cost. In any order, doesn't matter. I need the mid number. Khalas. Okay, NRV is the selling price minus selling cost. That means 20. From this 20 NRV, deduct the normal profit margin, 5, that gives me 15, and then take the replacement cost that is given 10. In any order, I need the mid number, not the mid location, Salman, for God's sake. That was offensive. I need the mid number. Which of these is the mid number? Mid number is 15, right? And interestingly, the location is mid as well. Salman got it right. So 15 is neither too high nor too low. The middle number is to be taken, not the middle location. So this is going to be a designated market price. So that makes B to be the correct option, and B it is. Now, how you can apply NRV or the LCM rule? There are certain important points to be considered before we move on. Either you can apply LCM to each item separately, LCM, 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 or let's say if you are talking about IFRS or US GAAP for FIFO and other methods, LCM, NRV, NRV, NRV. You can apply the NRV rules or LCM rules individually on these items. This is allowed. Or what else you can do? You can apply on each group of items, means all the furniture, all the computer equipments, all the vehicles in your inventory. I'm not talking about your long-lived assets, the items that you sell, that you trade in, because inventory means the items that you trade in. So you can apply this LCM or NRV rule on single item or in group of items, or the third case, you can apply LCM or NRV method or your entire inventory. It's totally your choice. IFRS and US GAAP has no concern with it. One by one, or you apply this on entire inventory, all methods are perfectly fine. What you need to remember is that loss once written off, under the IFRS, the loss can be reversed subsequently, but under the US GAAP, the write down cannot be reversed. And that is the stiffness gauze we were talking a little while ago. Okay, now this is the question you people should answer. I'm expecting correct answer from you. The lower of cost or market rule, also called the LCM rule, which is of course applicable only under LIFO and retail method and only in the US and China. Keep that in mind. That is essential. So the LCM market rule for inventories may be applied to total inventory or to groups of similar items or each item. Think about it carefully and give me the answer. Which application generally results in the lowest inventory amount? Should we go for all items in a go? Should we go for groupings, or should we go for each item separately? Which of these will give you the lowest value of inventory? Nabil, excellent. D. If you take on every item separately and apply the LCM rule on every item separately, every item in your inventory would come at the lowest value. Hence, your total overall value of your stock would be the lowest. If you take as a group, then maybe some under and over might make things different. So that's the important point to learn. All right, moving on. So that's right. D is the right answer. So gentlemen, this is how you write down your inventory. You debit the loss on write down inventory and you credit your inventory. The entry is same whether you use under IFRS or US GAAP. The difference is that the US GAAP does not allow reversal. IFRS does, and the reversal should not be more than the previous write-off. Let us do this question. A distribution company has determined its December 31st inventory on LIFO basis at $200,000. So this is the value of inventory under LIFO cost, which means you will apply LCM rule, not NRV. Remember, LIFO and retail method means you apply the LCM rule. Under LCM rule, you will need three circles in any order. The first one would be for NRV, or in any order, take replacement cost and NRV minus normal profit margin. Okay, so estimated selling price is 204, estimated disposal cost is 10, which means your NRV is 194,000. Okay, if you deduct the normal profit margin from 194, you get 164. This is your NRV minus normal profit, and the replacement cost is given as 180. What you do, you take the mid number of these three. So this is the highest This is the lowest. Interestingly, your replacement cost falls within these two, and it's also in the middle position. So this is going to be your designated market price. This must be matched against your cost, and it clearly shows us that the cost is $200,000, whereas the replacement cost is 180. So yes, there is a loss. And this loss of $20,000 must be recorded in your financial statement. The loss the company should recognize is 20. And since it's LCM rule and we are talking about the US GAAP, there will be no reversal. That is the rule based. No reversal, whatever the market price subsequently may be, the loss is gone. So that makes D to be the correct option. Now, this would test what we have learned regarding IFRS versus US GAAP. Which of the following is true regarding inventory adjustments under IFRS? Which of these is true? Let us analyze each option one by one. IFRS do not require inventory adjustments. They do. This is a false statement. Reversal of adjustments are allowed in subsequent periods. Yes. IFRS allows you the reversals in subsequent periods, but not more than the previous write-off. A reversal of previous write-down may be higher than the previous write-down. No, only equal to, not higher. This is false. And adjustments may not be reversed in subsequent periods. Under US GAAP, it is true, but under IFRS, you can reverse. So this is not true as well. Under GAAP, it's true, but not under the IFRS. And currently, we are doing under IFRS. So that makes B to be the correct option. And that ends your unit 2. Luckily, I thought we might extend the topic, but it has finished. So we will be starting our unit 3 on coming Monday, inshallah. So please make sure some fine points here and make sure you do it well. Raj says, last question, how you identify method? Look at this. IFRS. And IFRS clearly means that any subsequent adjustment can be made. Yes. IFRS requires inventory adjustments. Reversal adjustments are allowed in subsequent period. This is true under IFRS. Okay, Salman. Okay, guys, that's the point we have. Second point C, explain karo, Subhan. Reversal of previous write-down may be higher than the previous write-down. See, let's say under IFRS, you wrote down $20,000 of your inventory in 2021, right? Subsequently, the price went up. When the price went up, the loss can only be reversed up to 20,000, not more than the current price. The previous write down can only be reversed subsequently. If the prices have gone much higher, you cannot reverse the loss more than 20,000. Only what you wrote down you will reverse, right? I hope you got the idea, Rahat. It was IFRS and we have to solve each option, keeping in mind IFRS and NRV rule. All right, guys, gentlemen, ladies, I will see you guys on coming Monday with a new chapter. And please do review and repeat these topics. And inshallah, on Monday, we'll be starting a very important topic, equity investments. We'll discuss different types of debt instrument, debt investments, and equity method as well. So see you guys coming Monday. Take care. Bye-bye. Have fun and keep practicing. Good luck. Allah Hafiz.